I'm about to do something I don't normally do on this channel. If you're a high-income earner sitting on a big tax bill this year, and you've been thinking about getting into some sort of investment in real estate, but you're not really sure how to evaluate a deal from a tax perspective, this video is going to change all of that for you. Instead of teaching you some concept or walking you through some strategy, I'm going to pull up an actual property and we're going to walk through the listing and how I would evaluate it from a tax perspective, right here in front of you. This is the process I go through when a client comes to me and says, Ryan, I think this is a good property. I'm serious about it, but I need your opinion from a tax perspective if this is going to help me accomplish my tax goals. What do you think? So I look at the listing and I start pulling up numbers and information I need to help me evaluate from a tax perspective if this is going to fit into the overall plan and help them accomplish their tax goals. Honestly, most CPAs don't think this way. They see a property and they just think about the tax return. I see a property and I think about the deductions and the tax savings. So if you've ever wondered what it actually looks like to walk through a property and how do we evaluate this like a tax strategist from a tax perspective and tax savings, stay here and we're gonna walk through that together. I'm gonna walk you through exactly how I analyze the listing, how I pull the property tax data, and then I'm gonna help you see how I turn those numbers into an actual tax saving strategy for a buyer like you. Okay. So here is the listing itself. What I did was I did a search. No one gave me this property. I simply did a search on Gemini and basically told it a few key things that I was looking for, and it gave me a list of 5 different properties. Some of the criteria I was looking for when I did my search: I wanted a property between $500,000 to $1 million. I was generally looking in the Gulf Shores, Alabama. I know that some people buy down there, and I've seen that as a pretty good priced location. That's by no means any sort of a recommendation for this area specifically. I also was looking for something with a pool, proximity to water, things like that. So just kind of giving you a sample. If you're doing this by yourself, first, I would not recommend doing that. There are lots of companies that can help you identify the right budget for you, kind of the right location, the right amenities, which properties are going to do well. I'm happy to send you some names if you're interested in that in working with me. But just know that this is a review primarily from a tax perspective. So here's the Zillow listing, and you can see it's 3965 Lafitte Boulevard. Again, don't know this person. Looks like it's a relatively new listing. 4 days ago. Looks like it just came on here. So here's the first things that I'm looking at. Number one, purchase price. So you've got to first identify, okay, does this fit into your budget, right? Whatever that might be. How much capital do you have? How much do you have to deploy? If you're thinking 10%, 20% just based on your financing, you also need to be thinking about things like, financing, closing costs, potential renovations, potential furniture you need to have, all those sorts of things. But first, we're just going to assume as we do our tax analysis and just looking at the property first, we're going to assume that we buy the property at this purchase price for the listing. Now, next thing I can see right away in the pictures, and we're going to just kind of skim through all of this, otherwise it would take forever to look through this. So first thing I noticed is the pool, and that was something that I had put in my search on Gemini here as I was looking. And part of that is not only because I've seen a lot of properties do well when they have a pool, but also because there is going to be a good amount of bonus depreciation when a cost segregation study is done, and we're going to assume that that's going to be the case here for this property, that's going to be valuable and worthwhile, that this is going to be a huge piece of increasing from our purchase price, how much is going to be allocated to 15-year property, land improvements, because we have an outdoor in-ground pool. Some of these other things, the property just overall looks nice, which is great. I think it said it was built in 2004, so a little bit newer compared to like a 90s, 80s type property. Looks very nice. Overall, a fairly modern look, which when people are booking, they're looking for generally nice. Probably a bigger driver is going to be things like amenities. So again, not too much I want to comment on here. In the inside, the size of this 4-bedroom, 5-bath is a decent size. You probably aren't going to fit 10 people unless you really stretch it. The 2,970 square feet, again, a good size, but not some massive place if that's what you're going for. One thing that I would be questioning too if I was looking at this is the furniture included, or is that something that I'm going to have to figure out and buy myself? That would be a key aspect to determine. And then just kind of continuing to scroll through, again, a lot of nice things in here. One thing as well as you consider maximizing revenue, again, I'm no expert by any means, but just a good design. Like as you look at this probably feels nice to a lot of you. A good design, cohesive, things like that are going to be very important. We've got some appliances, which is good. This is actually a part that I found very interesting. It almost looks like a garage door opener over here. I wonder if this was kind of a garage conversion. It does look like a car there. It's a little bit hard to tell. Yeah, it looks like the garage door opener there. So very interesting because they took something that probably was just for a vehicle and now turned it into a space that they could really have people use as obviously a game room here. And so this is gonna, in my opinion, help you from a cost segregation study perspective. Again, does the pool table come with this? Does all this come with it? You've got some more space here that we can use and be able to potentially just have more space for people to be able to utilize for the enjoyment of their trip potentially. So a lot of good things here that I would be seeing as well. Yep, that's definitely the garage. This part is another piece that I would look at and say, hey, this all looks to me, no cost segregation study expert, I'm not an engineer, but to me, this would look like 15-year property, having this kind of outdoor deck area, fantastic. And as well, you can see the water here in these pictures, that's fantastic. Access to water is going to be a good indicator that this could be a good place, because when the people go on vacation, they're willing to spend more to be close to water. Whether they get in or not is a little bit different question to ask, but proximity here, people are going to enjoy this a lot. You've got these additional kind of couch bed thing here, which is great. Again, just more space for people to use, and that's going to be fantastic. This we could look at this, but this might be one that has like a boat slip. Very interesting. So I don't think you're gonna own any of this, which would normally be something that's 5-year property, but there could be a unique feature here in terms of what might be bonus eligible. I won't comment too much on that, but obviously they're showing several pictures of that to maybe just show that you have a slip and you have access to that. Again, very valuable depending on what you're gonna use. If you're gonna have a boat that you're going to rent to people, there is obviously some legality behind that. You need to make sure that you've got a well-documented thing. You know, is that included with the rental or not? But even if not, and people can just bring their boat, again, going to be pretty valuable. Overall, looks like a nice property. Yeah, fantastic. Again, the pool, they're highlighting a lot of bonus eligible property there. That's fantastic. So this would be a great property for a short-term rental. That's kind of what I'm assuming, not a long-term rental, not a multifamily, obviously, but potentially a short-term rental. A lot of my clients who are going to be working with me are evaluating the short-term rental tax strategy. So we're going to assume that's the case here. From the outset, and just a couple looks from a tax perspective, very good. So let's move on, and let's say that you are a high-income W-2 earner and you make $1 million a year from your W-2. You're going to be in the 37% tax bracket. We'll assume that, and let's assume that we're going to say we materially participate in this property. It's a short-term rental. What does this look like from a tax perspective? So the next question we need to ask ourselves is, how much of my purchase is going to be allocated to the building compared to the land? And as we saw in some previous pictures, there is some water over here, and so that's going to have a impact, you'll see, on the percentage that's going to be allocated to the land versus the building, or at least typically that's the case. And a good average rule of thumb is about 80-20 split, 80% to the building, 20% to the land for most properties in general. But usually when we get closer to the water, it's on a lake, we're going to see probably 60-40, 70-30, something like that. So I'm going to transition. I had already pulled this up just to make this fast. So for this property specifically, I'm not going to show you everything here. But basically, what we see is a land value, and this is from the property tax assessor, Baldwin Property County. The land value here is $264,200. The improvement value, which is basically the building value, $669,500, for a total appraised value of $933,700. Now, if I just pull up calculator here, we're just gonna take, to figure out our percentages, you don't use the exact $264,200, okay? Why is that? Because the appraised value is different than your purchase price. Again, we're gonna assume the listing price is the same as the purchase price, okay? So what you do is you take the percentage, the $264,200, and you divide that by the $933,700, which gets you to, we'll just say, for example, 28%. Okay, so 28% is going to go to the land. The remaining amount is going to be to your building. 72% building, 28% land. So then we multiply that 28% times our $899,900. That is your land building. Sorry, your land portion. The building is going to be the remaining amount. We'll eventually show you kind of a full spreadsheet here that I've got going on. But at the end of the day, that's going to be our split for the building and land. And that's going to be important. Again, this is a pretty good percentage, 70-30, just under that, for a property that's right on the water. That's very good. All right, so you're starting to see how I think through some of these deals. And this is really just the surface level. When I work with clients at Carrier Tax Consulting, I go way deeper than this. We look at things like entity structuring, material participation, cost segregation study timing, and how the property fits into your overall holistic tax planning, not just this deal in isolation. If you want this level of analysis on a property that you're getting really serious about, then book a call with me in the link in the description and we'll talk through some things. Okay, let's keep going. So back into this, just as a refresh, you cannot depreciate the land. Okay, that's why this is important. When you buy a piece of property, you're almost always buying both the building and the land. Okay, condos can be a unique thing. Sometimes there's land leases that can be unique, but this is a property where clearly it seems that you are buying the land. So we're going to use this for our example. And again, this is a pretty favorable ratio, roughly 72-28%, considering the property is on the water. But now that we have that, let's kind of take into consideration what the bonus depreciation might be. Okay, so going back here, I typically see as an average kind of a range about 20-30% of a building, a residential property like this, is going to result in bonus eligible property. And as a refresh, there's the 5-year property, 7 and 15. Okay, 5 is personal property, 7 sometimes is some furniture, some other business equipment, things like that. And then 15 is land improvements. That would be things like this driveway here that you can see, or the pool is typically going to be 5-year, or that deck that we saw outside. So those are kind of the key aspects. When I see a listing and I see a lot of this 15-year property, like the pool and the deck outside, that to me says, hey, we can probably assume a much higher percentage of our building basis is going to be going to that bonus eligible property. Okay, so let me now pull up a spreadsheet that I've put together for this video specifically for this property. So this section, we're going to walk through some of the tax analysis. And again, I've just got the property here in case I was using this in the future. So purchase price is that $899,900. That was the listing price. We're going to assume that for now. The building, right? We just walked that through. Kind of the building and the land split, where you're going to use 72% of the purchase price is going to be our building. The land is right here. Now, of that building, remember 20-30% of that is typically going to fall into our bonus eligible property. So I'm going to assume, because we've got the pool, because we've got that kind of wraparound deck outside, I'm going to actually push for about 30% of our property here. The building is going to be allocated to bonus eligible property. So that gets us to the 194 number. Now, again, assuming you're this high income earner, W-2, making $1 million a year, you're going to materially participate. You do a cost segregation study to get this. I would estimate just for the federal side, and all the states are a little bit different, and I primarily see this as a federal tax benefit. You are looking at, just from this one property, $71,920. Okay, now that is a lot, and I realize that, and that's why people go with things like this, right? They're looking for things that are going to have a good, just immediate tax savings for them because they're tired of paying taxes, right? But let's take it one step further and say, what about my financing, right? What's the difference, Ryan, between if I put down 10% compared to 20%? And I like to show this because this gets me ultimately to what I call a return on tax savings. It's part of your return on investment, but I'm just trying to be specific here to say, hey, if your property never appreciated, if you never had any debt pay down, and you've never had any cash flow, what would just the exclusive tax savings be? So if you put down 10% and you received tax savings of this, so your down payment's $89,900, that would be an 80% of your investment comes back to you immediately in the first year from the time that you make this investment. 80%, it's almost 80%, it's like 79.99%, okay? That is massive. Very difficult, in my opinion, to find a investment that can result in 80% of your investment coming back to you in the first year in the form of just tax savings, okay? And again, other benefits there, I'm just highlighting the tax pieces. Now, 20% is gonna be about half, which makes sense, right? It's the same tax savings for roughly the double the down payments, okay? Pretty intuitive for most people, okay? Now, we could take this a step further, and let me just show you this too. So let's just say return on time, okay? You've got to put in, as we talk about material participation, you've got to put in that 100 hours and more than anyone else criteria, okay? So if we do our 100 hours, and let's just say we are going to put in this over 100 hours, you're getting a $719.20 hourly rate, okay? $719.20, okay? for all those 100 hours that you put in to renovating the property, for some management, for some of the buying time, all those things, that time that you're putting in is going to equate to after tax, not before tax, after tax $719 per hour. Okay, so not only is this a extremely efficient use of your time, right? 100 hours. We're not talking a 2,000 hour a year job. You don't have to quit your W-2 job to keep making your $1 million. But also, in terms of just the money you put in, depending on which one you go with, it is a 40 to 80% return on just the capital, right, that you deploy. We're not talking about closing costs. We're not talking about renovations, anything like that. All for this $70, almost $2,000 back in your bank account, okay? Then now you can use to do whatever you want. You can add more to amenities and renovations. You can save it up for the next property that you buy next year, whatever it is, right? But all that to say, very good tax savings here. We've got a lot of kind of leverage here that we're using to get to these tax savings at 10%, 20% down. And it's a very good use of our time. Okay, this $719 that we've got here. Now, I have this pretty simple checklist of how I evaluate with a client, is this going to be worthwhile? Or kind of things I evaluate from a tax perspective. So price, right? That's the $899. That's a good price, right? If you're making, say, $2-3 million and you're looking at a $500,000 property, that's going to make some impact, but it's not going to be the same amount as, $72,000 that you're going to save. So price, make sure that it's worth your time that you're going to put in. So price is one aspect. Does it fit your budget too? Year acquired and placed in service. I'm assuming 2026 acquired and placed in service, which means we get 100% bonus depreciation. That's what we have right now with the One Big Beautiful Bill. Building land values, we went through that pretty in depth. That's the 70 to 28% split. That's good, right? Sometimes I've seen properties in California or other places on the coast. They can be 50-50 or 60% to the land or 70% to the land. And if I were evaluating a property before I acquired it, that would be something that would concern me to say, hey, I'm going to put all this money in, I'm trying to get all these tax savings. It doesn't have a good amount of depreciation, which is a big factor in getting these tax savings, then it ultimately just might not be the best fit for what I'm trying to accomplish. Okay, so building land values, that should be high. Bonus eligible property. That's why I look at the listing to say, hey, does it have a pool? And does it have a deck? Does it have some other aspects that are going to increase, usually outside the land improvements, that are going to increase a lot of bonus eligible property. Okay, and that's really going to be the cost segregation study results there. Okay, renovation costs and timing. For this example, I didn't assume any sort of renovations were going to be done. But that is going to be impactful as you think about, hey, I have to put in, $200,000 into this, or I have to put in $50,000 into some furniture and just a couple small improvements. Well, depending on the timing and the full cost, all of that or some of that additional $50,000 could be eligible for bonus depreciation. Okay, so that'll be a factor. We're not running through that in this video, but that's impactful. HOA issues. Okay, this one, if we go back, this one did have an HOA. You can see that pretty easily here. So $325 a month HOA. That is something that's just going to be an additional piece to maybe some restrictions, maybe some issues or concerns. Do you like that? What do the rules say? Can you actually use it as a short-term rental? What is included in that HOA in terms of other amenities, things like that. Okay, so that's the HOA issues. Access to water. We saw that it seemed to be right on the water, so that's fantastic. Again, whether people actually use it or just are near it or whatever, that is going to be valuable in terms of what you have. It's not necessarily going to be a tax benefit. It is a tax piece that is a part of the equation to say, okay, that's probably going to impact our building land, but like we just saw, it's actually not too far off like an 80-20 split that I normally see from, properties from an average throughout the US, but it is something to consider to say, oh, I really need to make sure I check that number here. So that's another one. And then restrictions to being an STR. Okay. Now, as I was preparing for this and as I was doing this, I found out after I went through all these things that right at the end, I knew this was going to be something I needed to look at. And I did a quick search on just the listing. And if I go to even just something like Control F and I do rent, right? There's 10 things, but none of them are related to this listing's description. Okay. Nothing in here is talking about rent. It's all elsewhere. It's all behind here and stuff like that. And that was like, I was kind of wondering what was going on with that. And so what I did from there is I then took this and I pasted it back into Gemini and I said, hey, can you tell me if there's any restrictions, whether it's an HOA or local or whatever it might be for this property? And pretty quickly it came back and said, yep, this is in the area of Gulf Shores that short-term rentals are regulated and you cannot do a short-term rental here, apparently specifically in this area of Gulf Shores. So I put it last in my little video for you guys here and in my analysis because I ultimately kind of did this backwards. This is where I should have started. This should have been number 1 on my checklist instead of at the end. So make sure that as you're doing this and as you're doing your search, and if you're working with a company who's helping you, hopefully this is the first thing they do. But all that to say, it was very fun going through this, but also I feel like kind of a silly thing in hindsight that this, again, should have been number 1. Because if we do all of this and I say, hey, you can save this, and hey, it's 80% of your return on tax savings, and hey, it's $719 based on your time, but then we get to the end and we say, oh, the city won't even allow you to get the average stay per guest less than 7, then it was kind of all for nothing, right? So make sure we start with that. It's a huge piece. Regulations are changing all the time. So just make sure that you actually evaluate that right away. Don't make it last like I did. So going back to this listing, this property absolutely is a no because we can't even rent it based on the regulations. So this would be a pass. Again, moving forward, make sure that you do that right away and that's a big part of your analysis immediately. Right? Hey, I'm looking at this property in this area. Does it seem like there's any local or even HOA? That's why I consider it as a potential issue. HOA restrictions that might say, nope, you cannot rent this as a short-term rental. So just keep that in mind. So yeah, final analysis, great property if we could do a short-term rental. And I would also be asking my client things like, hey, how much, do you have to put down? What is your budget? What else do you have for other properties? Can you commit to getting 100 hours of material participation? Do you want to continue to buy 1 property a year, or how many a year are you planning to buy? What is your income expectations for this year compared to next year and the following year? Just kind of helping me understand, is there specific years that we're trying to offset or any other major taxable events that would help me understand what maybe purchase price we're looking for. All right, so now you've seen me evaluate a real deal live and how I break down some of the key tax aspects. But I want you to notice something. This entire analysis happened before anything happened, before anything was purchased. The time to think about strategy and specifically tax strategy is before you acquire anything, not after. Because once you've signed, your options shrink and the more mistakes are just gonna be more expensive. If you wanna understand one of these strategies I used in this breakdown video, go watch my video on cost segregation studies where I walk you through a step-by-step of how this works. And I'll link it right here on the screen for you. I'll see you in that video next.